Shares for beginners. Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
We make X amount of money from running the business. We sell X amount of stuff. It costs us Y to buy. We have to pay our employees and we pay the rent, and that gives us a profit. And then we have to spend a bit of money upgrading our corner store each year. And so the free cash that comes out of it is after that. I want to know, what's that cash number at the end of each year?
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. You might have realised by now that I love looking at the metrics that experts use to size up listed companies. There's plenty of fancy sounding jargon for the various tape measures that will tell you whether or not a company is worth your hard-earned dosh. Today I'm welcoming back Andrew Brown from East 72 Holdings to talk about his favourite barometers and yardsticks. G'day Andrew.
G'day Phil, nice to be here.
Thank you very much for coming on. Now I've been toying with the title of this episode and I was thinking about calling it I've Never Met a Metric I Didn't Like. Are there any metrics that you personally disapprove of?
There's actually lots, Phil. Probably my favourite metric I really disapprove of is discounted cash flow valuations.
Hang on, that's one I hear so many people talking about. They love DCF or discounted cash flow.
Absolutely. Yeah, they love discounted cash flow because you can fit any story you want to discounted cash flow. Just for the benefit of your listeners, discounted cash flow is where you look out into the future and you project the company's cash flow, its free cash flow, and I'll talk about what that means. But let's just, for the time being, just to get the exercise across, let's just say you project the company's profits and the cash that comes from that profits way out into the future. So most people do that. If they do a proper discounted cash flow, they will actually explicitly forecast 10 years of profit. And then from year 10 onwards, they do what's called a terminal value. Okay, and the terminal value is actually quite a simple calculation. It's the sort of things you do at school where you actually take the cash flow, you take an interest rate, you deduct the growth rate from it, you divide the first by the second, and you get a number. And the reason discounted cash flow is such utter garbage is, first of all, that terminal value usually ends up being 70% of the total value. The second reason it's total garbage is you have to project 10 years out into the future. Now, let's say you have a building materials company. Try and project that 10 years out into the future. Do you know what housing demand's going to be? There's going to be at least one or two upturns and downturns, so they're going to make a lot of money over a couple of years and then maybe not do so well over a couple of years. So the only areas that discounted cash flow really works in are long-term assets. So things like motorways, things like airports with some caveats, because obviously airports can move up and down a little bit, obviously if you have COVID and SARS and things like that. But by and large, they have really, really predictable cash flows. So you can actually predict what a motorway is going to earn 10 years from now with a reasonable degree of certainty. Whereas obviously, trying to basically understand what a bank's going to earn 10 years from here, or just a standard industrial company and certainly a retail company, is pretty much impossible. So if people start throwing discounted cash flow or net present value at you, and it's just a normal company, not a long-term asset, put the phone down.
It's interesting because you refer to the difference then between infrastructure companies, because you can predict their cash flow because it is based on an actual number that they're going to be getting from tolls or governments or so forth. That's the way that works, isn't it?
It is indeed, yeah. I mean, the big things with infrastructure companies are, many of them, particularly if it's a toll road, there's usually some kind of inflation proofing for the toll road
Well,
operator.
we've noticed that with every toll that we go through. Every 6 months you get that little sign up as you enter the tunnel.
Absolutely. To go from Sydney's centre to its west is about $17 now if you use two toll roads, the Eastern Distributor and West Connect. Or Cross City Tunnel, sorry. So, yeah, there's sort of inflation proofing on those things, which makes them a little bit easier to use. And also, it's pretty predictable. Basically, the amount of traffic once they're up and running just really correlates with the population. And now and again, you get a nice little bump because there's a new suburb built that wasn't expected to be built adjacent to the toll road. And so, of course, that increases the number of people over and above what you would have otherwise predicted. But by and large, for normal companies, as I say, if somebody comes to you saying it's really cheap on a DCF basis, just wave goodbye to them.
Yeah, I've never understood that, how they can talk so authoritatively about a number that just seems to lie within so many uncertainties and predictions and, putting your finger into the wind.
One of the worst things, Phil, about DCFs, in one sense about analysts in general, particularly what's called sell-side or stockbroking analysts, what's amazing is most of them have a valuation of the company that's relatively close to the share price. I've been quite happy at times when I've written about companies. I wrote to some people quite a few years ago about a company called National Hire Group, which is now part of Seven Group Holdings. So National Hire does basically plant hire and stuff like that. And the shares were trading at $1.20. They're relatively thinly traded. Two guys owned about 80% of the company. That was Kerry Stokes and Dale Elphinston, the richest man at the time in Tasmania. And the shares were $1.20, and I thought they were worth $3.60. So imagine writing, and you say to people, hey, these shares are worth 3 times what they're trading at. Most people would have, sent the men in white coats to come and, lock me up. Because other analysts would have sort of said, oh, we've got a DCF valuation, and it's $1.50, or something like that. So what you find is analysts sort of cluster around the share price in terms of their valuation. And then when the share price goes up, guess what? Their valuation goes up. Why? Have they discovered something new about the company? No, it's just the share price has gone up. So you've got to be really wary, of people that basically fix their valuation. And I do mean the word fix, because you can fix a DCF any which way you want. You just change the growth rate of the cash. You change the discount rate at which you're discounting $1 tomorrow back to today. You change it from 6% to 5%, and instantly your valuation goes up. So those are the kind of things where, if I see stockbroking research that's full of DCFs, other than infrastructure and its ilk, then, I'm not interested. So that to me is, just leave that alone.
When preparing for this episode, you said that you focus a lot on differentiating the business from how it's financed. What does that actually mean?
Well, what it means is basically, I'm going to use a really simple example of a corner store. Okay. So basically, if you own a corner store, you might have a corner store where you very much bought it outright. There's no debt in the business at all. You might rent the store, and I'm going to come back to that concept in a minute. But you basically run it, there's no debt, and so all the cash flow that comes out of the store basically belongs to you. On the other hand, you might own a corner store, but you've borrowed a lot of money to do it. And so when we look at the picture in totality, then whilst the corner store is going to do exactly the same, one assumes, of course, what the bottom line looks like is going to be very, very different. And the reason I differentiate the business from the financing of the business is that, of course, it is possible to change the financing of the business. So that if you found it to be a little bit difficult to run the store because you were paying too much in interest, then what you can do is you can sell a little bit of the store, refinance, pay down the debt, and you still got the store, maybe not 100% of it, but the business itself is not going to change a lot. And so that's why I try to separate the things out quite distinctly. And it also changes the valuation of the equity if you have a lot of debt, even though the underlying business is exactly the same. Can I give you a really simple example?
Please do.
In terms of just some numbers. Let's say you have a business that makes $10 million a year in profit, and that's profit before interest or tax. Now let's assume you have no debt. So that $10 million is going to be $10 million of profit before interest. There's no interest, so it's $10 million of pre-tax profit. You pay 30 cents in the dollar tax, and so you'll make $7 million after tax, and the stock market might judge that business as being worth a 14 times multiple. So 7 times 14 is 98. So your store, the equity of your store, because there is no debt, is worth 98. Okay? And so the total value of your store, because there's no debt, is 98. Now that's the Muscatello store. Okay? Because Muscatello stores are very conservative and smart. But
Lots of olives and Dalmatis.
That's right, exactly. And then we have the Brown store, which is not selling Dalmatis and everything else, it's selling English sausages. So my store makes $10 million a year before interest and tax, but I've got $50 million of debt against it. So my $50 million of debt, I'm lucky enough to have a nice bank who only charges me 5%. So my $50 million costs me $2.5 million a year in interest. So the 10 minus 2.5 becomes 7.5 of earnings before tax. The tax on that is 2.25, and so the after-tax earnings is 5.25. So if we multiply by 14 times, now it may not be 14 times, that's about 73 and a bit. You just take my word for it. But the business has got 50 million of debt. So the equity's worth 73 and a bit, but the debt's 50. So altogether, Brown stores are worth much more than Muscatello stores. In total, the total value of the company is about 123.5. And yet the businesses are no different. They both make $10 million a year of earnings before interest and tax. And it's simply because we've applied and put some debt into it that makes the total value, that is the equity and debt, worth a little bit more. Now, I've simplified it and assumed the after-tax earnings are judged at the same price-earnings ratio. In practice, they wouldn't be. The Brown stores would be a little bit lower, but I can tell you they wouldn't be sufficiently lower to reduce the total value of the business on exactly the same company. So that's why I separate out the financing from the underlying business.
So between these two stores, the Muscatello store and the Brown store, when you're valuating a business, you're not valuing the Brown store as highly as the Muscatello business. Is that why? Although other market analysts might be because of the amount of debt that it's carrying. Is that what I'm hearing?
At the bottom line, I wouldn't value it as high because it's riskier. Okay, because there's obviously more debt in it. So I wouldn't give it a PE of 14. I might only give it a PE of 12. But under most circumstances, the overall company will turn out to be worth more in what's called an enterprise value sense. That is the value of its equity plus the value of its debt. And that's why I think it's really, really important that you sort out the financial structures of the company from the company's operating capabilities, the operating profits it makes. And that's why I do that.
And it's interesting as well. There's a shortcut as well, can't you? You can look at the difference between the enterprise value and the intrinsic value, can't you?
You can indeed, yeah.
And that quickly tells you how much debt it's carrying, doesn't it?
That's correct. Absolutely right. And what's important, Phil, is that when it comes to valuing companies, I often value companies by breaking them apart. They might have two businesses, not just one. And so I value each of the underlying businesses, and then I deduct the amount of debt, and then that gives me a value for the equity. That, if you see it written in a research report, it's called a sum of the parts valuation, because I'm valuing business A, I'm valuing business B, and if there's a business C, I'm valuing that. I'm adding those values together, but then I'm deducting the debt of the overall, what would be a conglomerate at that stage, and working out a value for the equity. And so the value of that conglomerate is determined mainly by the values that I place on each of those underlying businesses. Okay, and if I change those valuations, then the debt obviously is the same, but it's determined really by the underlying value of those businesses. I'd love to give you an example.
I was just going to ask because I think we both love a beer.
We do. We both love a beer. Now, this is a really good example for the listeners because this is really rare in Australia. It does not happen very often. I actually don't know another one. I'm prepared to be corrected by someone that does. But there are very few companies in Australia that have a lot of debt and where the banks that they owe that debt to take a haircut. In other words, they agree not to get 100 cents in the dollar back. But
Sorry, am I hearing right? The banks lose money.
The banks
am I
lose
hearing
money.
that?
Yes.
And we're talking about Boag's Brewery here, aren't we? In the 90s.
We're going to come and talk about Boag's Brewery. You have to go back to 1996 to find this one, but it's Boag's Brewery. Now, what I should add is banks don't take haircuts very often because they love administrators, so they appoint administrators. Boag's back in sort of 1995 found itself in a bit of a tricky situation. It owned quite a few pubs in Tasmania. It had 40% of the Tasmanian market, obviously against its mortal enemy based down in Hobart. Boag's, of course, is in Launceston, against its mortal enemy Cascade based in Hobart. And in a quirk, funnily enough, Boag's was actually the distributor for Cascade through the rest of Tasmania, which was very funny. So Boag's was actually controlled by a guy called Phil Adkins. Phil had taken a big equity stake in it when it was mired in debt. It actually had $200 million of debt, and it was only turning over about $50 million a year. So you can imagine that wasn't going to work. So Phil sold off some assets that weren't doing very well, and Phil managed to get the debt down to $102 million. But that was still a little bit uncomfortable. So in 1996, and it's the only situation I've seen, and as you imagine from the way I'm speaking to you, when the fund was running at the time, we couldn't buy enough of this stuff. Okay, and I'll explain why. So Boag's, before it got the banks to take a haircut, had $102 million of debt. The banks took a $50 million haircut, and Boag's raised $14 million from investors. Now, the share price before the raise was 45 cents, and it said to investors, look, you're getting the benefit of the haircut, so we want you to put money in at 60. So the funds I were running were part of the people who bought as much of this as we possibly could. So the debt came all the way down from 102 million to 38. And the business basically could service $38 million of debt because it was making about $5 million of earnings before interest and tax. So within 4 years, the debt had been paid down a bit further. The debt got paid down to $8 million by the sale of some hotels, but the equity went up threefold. We got a takeover bid at $1.65 a share. And funnily enough, when you look at Boag's, after it had been recapitalised, the debt was $38 million. The value of the shares was about $36 million. And so the total value of the company was $74 million. When it got taken over, the total value of the company when it got taken over was $100 million, of which 92 was attributable to the equity, and there's only $8 million of debt left. And the business didn't actually do that much better. It did a little bit better, but not that much better. So it only went up 25% in total value over a course of 4 years. But all of that accrued to the equity because the debt got paid down a bit further and the debt had been lowered. And so the business did no better. But because of the financial structure, the winners were the equity holders, and particularly the guys that put money in at 60 cents and got bought out by San Miguel, Eduardo Coanco, the big racehorse owner of the time, at $1.65. Now, if you think Mr. Coanco overpaid, don't worry too much, because 7 years later he sold the whole shebang to Lion Nathan for $325 million.
Wow, not a bad deal. So the lesson is that the way the business is financed, how much debt that it holds, how much interest that it's paying has a real material effect on the price of the share, what you're calling the equity. Yeah,
absolutely. Obviously, if you get a business that's not doing well and it turns around and it has a lot of debt in it, then the value of the equity will skyrocket. Okay, so that's why people often speculate on companies with a large amount of debt that they think will survive because the value of the equity will go up very, very sharply. And the best example I can think of in more recent times was the shares of Seven West Media. So that's Channel 7 and the West Australian and some other bits and bobs. They got down in COVID, I think it was, or just before. They got down, they had a lot of debt. They weren't doing very well. The shares fell to 6 cents. But because the company started doing a bit better, the shares went from 6 cents to 40 odd cents inside a year. So 6 times your money inside a year. Now, they're still struggling, obviously, because the structural impasse on free-to-air media. But there was a period of time where people thought that wasn't going to be quite as bad. The company were doing better. Because they had a lot of debt, then that meant that a small move in the total value of the company all accrued to the equity. And so that's why people punting and speculating that it wouldn't go broke made a lot of money.
Wow, it's so counterintuitive thinking about that if a company's not doing well and it's got a lot of debt, because you're often told, look at the balance sheet, look how much debt's on the books, look at how much the company is making, that, I don't know, it seems intuitive that it wouldn't be a good stock to buy.
It sounds intuitive that it's not, but if it survives, if it's going to survive and just do a little bit better, that's the key. If it doesn't survive, you lose everything, obviously, and that's the risk. And so they're the kind of companies you might read an investment management report, somebody's annual letter or quarterly letter, and they talk about having one or two lottery tickets, inverted commas, in their portfolio. And they're the kind of things. It might be a highly indebted business that they think will make it through because of its cash flow characteristics or its positioning in its market. And so they don't have huge positions in the stock. They'll have a few pennies, like, if you will, a lottery ticket. And so that's the kind of thing they talk about. And that's why, again, dissecting the financing of the business from the underlying business is really, really important.
Super is one of the most important investments you'll ever make. But how do you know if you're in the best fund for your situation? Head to lifesherpa.com.au to find out more. Life Sherpa, Australia's most affordable online financial advice.
Okay, there's so much to take in there. But let's move on to EBITDA.
Yes.
And why don't you think EBITDA is what it used to be, as in a proxy for cash flow?
Absolutely. First of all, and there may be a bleep on podcast, I want to quote the late, great Charlie Munger, and he has a one-word description for EBITDA, which is bullshit.
We're happy not to bleep that. That's okay.
Excellent. That's okay. It's Charlie Munger as well. If it's good enough for Charlie Munger, it's good enough for me.
Well, it's a strong words from such a taciturn man.
Absolutely. Now, EBITDA really came into prominence in the 1980s. And why did it come to prominence in the 1980s? You may remember in the 1980s, it was a decade of leveraged buyouts and junk bonds and all kinds of, takeovers of companies to break them up and sell them off and refloat them at a massive profit for the underlying person. So, of course, it's the 1980s that spawned Gordon Gekko and Blue Star Airlines and all that kind of stuff. So why did they use EBITDA? Because at the time, and with the accounting conventions as they were at the time, EBITDA was a pretty good proxy for pre-tax, pre-interest cash flow. And if you're going to put a lot of debt into a company, and with the intention of either selling it on or breaking it up or whatever, then that's, as I've explained with some of my earlier examples, that's your key thing. It's what kind of cash does it produce before you start paying the banks, before you pay tax, and before you have to reinvest in the business, the capital expenditure that you have, even if it's just, to repaint the store or to, do whatever, let alone actually grow the business with new technology or anything like that. And I can assure you, none of the entrepreneurs of the 1980s were interested in investing in new technology or anything else. That just takes money out of the business. So that's why when you buy a business from those kind of people, you know that you need to spend a heap of money on it because it's old-fashioned, it's falling apart, but it's creating cash. Now, why is EBITDA in 1985 not the same as EBITDA in 2024? It's because of this wonderful body called the International Financial Reporting Standards. And if there's one group of people I rail against, it's accountants, because they've changed the rules to make things really difficult for people like me who we'll call securities analysts. Because they've changed two or three parts of the accounting rules which make things really difficult. So let's look at the first bit of that, which is the D bit of EBITDA, so depreciation. The accounting rules changed about 4 or 5 years ago, and if you're in Australia, it's called AASB 16, or IFRS 16 if you're overseas. And what does that do? And one of our biggest, best known, in fact, two of our biggest, best known companies basically were, their balance sheets changed forever because of this, and they're Coles and Woolworths. The reason why is that the accounting regulations now make you bring leases on balance sheet. So that Woolworths had whatever financial debt they had, but obviously Woolworths rent the vast majority of their stores, as do Coles, as do most retailers. But your future commitments to pay rent to Westfield and whoever, they now have to be brought on balance sheet. And I can assure you in Europe, it's the same thing, but European companies, when they talk about their debt, they include their leases. Now, I don't think leases are debt. They're a commitment.
No, well, the corner stores that we're talking about, you'd
That's
think
right.
that was just an operating cash flow situation.
That's right.
Yeah.
So what happens now, Phil, is that if you look at EBITDA and you see a company quoting EBITDA, because of where it is placed in the cash flow statement, you don't pay any rent. EBITDA excludes rent, because the rental payments, they're basically classified as, in effect, a debt repayment. So you see all these companies quoting EBITDA and there's no rental charge in it. It's nuts. And that's why most retailers, to be fair, you will see in a retailer's presentation, it talks about IFRS 16, okay, or before IFRS 16, because the retailer knows putting out profit numbers without rental charges in are patently stupid.
God, this makes it really hard for the mug investor to work out exactly what a company is making, compared to even you as an analyst who's doing this day in and day out.
Yeah, for mum and dad who may have a little bit of certainly arithmetic experience, but may not be an accountant, if you go to the cash flow statement and you see operating cash flow, if I say to you my operating cash flow, I'm a retailer, I make X amount of money, the operating cash flow, as I say, does not include the rent. It's really stupid. So EBITDA certainly in 2024 is not the same as it was in 1985. And the other aspect about EBITDA and the other aspect about accounting, which is, quite frankly, is so out there, is companies are allowed to capitalize expenditure on software at the behest of their auditors. So you take, for example, a company like, it's very much in the news at the moment, but not in the news because of its accounts, more of its, how can I put it, the interesting
of its
personal
founder.
habits
Yes.
of its chair.
We'll just leave it at that.
We'll leave it at that. The company's WiseTech. Okay. So every year, what you don't see, it is in their cash flow statement, but WiseTech every year, and it's a company that basically makes a pre-tax profit of about 370 million. Every year, they exclude payments for intangible assets, which is software. They capitalize that. So when you look at their operating cash flows, that's not in there. So there's all these people they pay to, create these whiz-bang programs and everything else, and I acknowledge they have a value for the future. Okay? But that should be captured in the stock price, not in the accounts. And so they basically shove $173 million of spend as investing activities. They don't charge it off in the operating part of the cash flow statement, nor in parts of the P&L. So that's another crazy little thing that goes on now. And so, if you have auditor A who's a bit strict and auditor B who just wants the account and is quite happy to go out for dinner with you, then I can assure you the two bottom line numbers will be very, very different. And so what you're seeing bit by bit is that the ability to not just use the profit and loss accounts for companies because of the change in accounting regulations, but the ability to use the cash flow statements has got more difficult. And if, like me, your key metric at the end of the day is free cash flow from the business before we start refinancing or doing anything with it, but it's free cash flow from the business, then I have to take, and obviously I'm very experienced and it doesn't take me very long at all, but I have to take every cash flow statement and I have to rearrange it. And ironically enough, I have to rearrange it back to what it looked like in 1985. Okay, so that we get a real business that the listeners to this podcast would really understand, which is we make X amount of money from running the business. You know, we sell X amount of stuff. It costs us Y to buy. We have to pay our employees and we pay the rent, and that gives us a profit. And then we have to spend a bit of money upgrading our corner store each year. We know we're going to have to do that, so we have to put that to one side. And so the free cash that comes out of it is after that. And what I'm looking at as a key metric is what is the free cash that is attributable to the equity holders after paying debt interest and paying for capital expenditure. So keeping a store nice, to put it simply, and perhaps also, putting in some new systems to make it even better, so some type of better point of sale system. I want to know what's that cash number at the end of each year.
Yeah, it's like me if I'm making the Dalmatis. If I get a machine to make Dalmatis, that wouldn't be in there. Or if I then was producing virtual Dalmatis, that wouldn't be. Is this the kind of analogy we can make?
If you buy a machine because you're going to be able to sell more Dalmatis because you're going to make them much quicker. And it's much healthier than you rolling them in your hand anyway. So, that's something. Sure, it's going to give you a better income stream going forward. And so one of the key things I always look for is what incremental return a company's making when they buy a new Dalmatis roller. When they buy new equipment, property, plant, and equipment, what's the incremental return? And so what I do, Phil, is I calculate the free cash flow return on equity. So I look at the value of the equity. So if I'm paying $200 for a business, I usually want to see if it's a reasonable business. I like to see somewhere between a 3 to 5, depending on the nature of the growth in the business. I want to see sort of 3, 4, 5% free cash flow return on the business, on the equity. And if I find businesses that are higher than that, I get really interested. Okay. Now, sometimes, of course, they're higher than that because the businesses are being run down. There's not much capital expenditure. You're running down your corner store. When the Dalmatis machine breaks down, you're going to roll them by hand again. You don't want to spend any money on it because you're going to try and sell it on to someone else. Okay. And get as much for it as you can. So I'm cognizant of what, companies invest into new equipment, but that's the key thing to me, because that at the end of the day is what you're buying the equity for, because it's that's going to finance your dividends. It's that free cash flow that finances the future growth of the business, not some other fancy pants thing. So that's what I'm really looking for if I'm going to buy shares in any kind of business.
Can I just clarify? A few moments ago, you talked about a 3 to 5% figure. Is that the amount to be spent on capital expenditure? Is that
No. That is the amount of money that comes out of the business after the spend on capital expenditure. If you will, to make it easy, it's net profit after tax minus capital expenditure. But rather than using the profit numbers, I use cash flow numbers, okay? Because I find them, by rearranging the cash flow statement, I find that a bit more useful because, profits obviously can be adulterated in various ways, the use of provision accounting and things like that. So I tend to do it on a cash flow basis. And if you think about it, if I'm getting 5% free cash flow return on the price I'm paying for the equity, okay, so not the equity that's in the accounts, this is the market value of the equity, the number of shares times the share price. If you think about it, what I'm saying is if I can get 5% in the bank and I can get 5% free cash flow return on the price of the equity, that's kind of equivalent, but I'm going to get growth from my equity. So if you will, I'm paying a sort of bank interest rate for cash flow, but getting the growth as well. So that's usually a pretty good deal.
Let's get to talking about Led Zeppelin,
Yeah,
which we always like talking about on this podcast.
absolutely.
Now, have you heard of Rick Rubin, the music producer?
I've heard of him, but I don't know too much about him.
Oh,
Can you enlighten me?
he was one of the founding fathers of hip hop music. He produced the Red Hot Chili Pepper albums, Tom Petty, but the last few albums of Johnny Cash, which you might be aware of, he was the one that revived Johnny Cash's career as well. And I was watching an interview with him, and he was talking about the way musicians will take music and then turn it into something else. And he gave the example of Jamaica, which is a great Led Zeppelin song, which is Led Zeppelin's version of reggae. And it doesn't sound like reggae, but it's reggae-ish, you know. So in terms of putting together your own suite of metrics, I mean, it sounds to me like that you actually have your very own bespoke version. It's like your version of reggae.
Yep, absolutely.
Do you think people and investors need to put together their own version of metrics, or should they be playing cover versions for the rest of their lives?
I think what you have to do is, I'm going to sit a little bit in the middle here, Phil, because I think what people have to do is they have to have metrics they're comfortable with. They have to have metrics that, you know, outside of really complex businesses, that they can pick up the accounts and they can calculate themselves. And they can not just calculate them, but they can understand what that calculation really means, and really means, you know, to their investment in that company. It's hard doing metrics on things like infrastructure. You're very much reliant on the fact that infrastructure businesses are, by and large, great businesses once they're up and running and mature. And, you know, the complexity of the companies underneath it are unbelievable, because they put each of the assets in a separate structure and they refinance the structures. And that's a bit of a nightmare for the average retail investor to do. But, you know, if you've got things like some of the companies I don't invest in very often, but when I do, usually do okay, is retail. Now, I use all kinds of metrics on retail, and the companies by and large give you plenty of metrics to actually work with. Retail's great. I love retail because most people don't realise why they make money out of retail. It's because it's very, very geared operationally. Now, you get extra dollars of sales and they fall to the bottom line. And of course, if you lose dollars of sales or go discounting, it takes away from the bottom line really quickly, because your costs are all fixed. It's rent, it's people, it's insurance, and things like that. And
rinse and repeat.
Yeah, absolutely. And so the only thing that changes is your top line margin. You know, like, can you charge a bit more for selling the same thing, or can you buy it a bit cheaper, or whatever it is. Once you've earned the top line margin, then what comes out after that is very, very fixed cost. If I can give you a good practical example in the stock market, one of my favourite retail stocks from a few years ago, and all my interns that worked for me used to get this as an exercise, was Baby Bunting. Mainly because at the time, and it's not the case now, Baby Bunting had relatively little competition. A lot of the competition had gone broke, so it was the Bunnings of baby wear. And baby wear and baby gear has particular characteristics about it. Mummy doesn't accept cheap baby wear. Let's put it simply like that.
Oh, don't get me started on car seats, how much the car seats cost and how long you've got to have them these days.
That's right. And what was going on with Baby Bunting is that they started to make a ton of money because they had the benefit of two or three things. They were opening new stores. Retailers opening new stores usually are pretty damn good, because if it's a good concept, they don't take very long to recoup the capital expenditure on fitting out the new store. Take about 2 years to mature, and then all of a sudden it's brilliant. It's money printing. But what you found when you financially modelled Baby Bunting, I had my boys and girls who came to do this, they all realised very suddenly, number one, it was so reliant on its top-line gross margin, which used to be 34%. It briefly went to 40%, which is why the shares went from $1 odd to $4 plus. And, of course, they tumbled all the way back. And the reason they tumbled all the way back was because their margin got crunched from 40 back down into the 30s again, and they'd expanded. There are a few other issues, and the accounting by Baby Bunting's a bit quirky too. And there's a lot more competition now, unfortunately, for them. But, you know, with retail, I look at things like sales per square metre, sales per store. You can actually work out rent per store, because none of them own their own stores. They all rent them. You can work out a whole bunch of things like that, and it starts to tell you really quickly whether the retailer is only growing because it's opening new stores, but its existing network's going nowhere. If its existing network's doing quite well and it's opening new stores, you have a recipe for, a bit of a firecracker, and it'll usually do well at least for a period of time, until competition comes in or something in the economy happens. So, with retailers, find as many metrics as you can. And Woolies and Coles are really good. They give you all kinds of stuff. Store numbers, they even give you square meterage and things like that. So you can use very specific things like that to get out, so you can analyze various parts of the business's performance. So when it comes to the bottom line, though, my favorite by a long way is what I described to you, which is free cash flow. So basically all the cash that comes out of the business minus the capital expenditure, and then divide that into the market value of the company and what kind of yield I get out of that. And that's what turns me on to things. I'm cognizant when I do that of what kind of business it is. In the fund I run at the moment, I actually own quite a few hotel stocks. Now, they're the kind of hotel that I'm very, very much willing for you to pay for me to have a night in, Phil. Sort of Peninsula in London, that's about $2,500 a night, pounds. Hotels are fixed cost businesses. And you have to reinvest in the hotel. You've got to paint it up, especially if you're charging that kind of money. And so, I'm very cognizant of when I invest in a hotel company, it's fixed cost. If the occupancy goes down, they start to lose money pretty quickly. But I'm very cognizant I invest in those on that metric, free cash flow return on the market value of the equity. And I've got a couple of others in France where they're high-end hotels as well. So they're the kind of things I look at. They're the kind of thing I especially look at when you just get run-of-the-mill, if I can call them that, businesses that, that make widgets and digits and sell widgets and digits and things like that. So that's my real go-to, but I do use a variety of other metrics, obviously, but that's the one before I really get interested in putting hard-earned dollars to work. That's the biggest cross-check.
Well, Andrew, thank you for bearing with my tortured musical analogies, but I think I'll be starting the Andrew Brown tribute band and do the covers rather than trying to be a completely original band in this instance.
That's right. Well, you won't have Andrew Brown in it. His voice and drum skills are absolutely appalling.
Fantastic. Andrew Brown, thank you very much for joining me today.
Thanks, Phil. Really enjoyed it as always.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.